Welcome to the Deep Dive. Today, we're getting into the recent Q2 fiscal 2025 results from SBC Medical Group Holdings.
Right, a pretty big name in the Japanese aesthetic medicine scene.
Exactly. And, on the surface, their numbers might have seemed a bit, surprising.
Yeah, a bit of a miss.
But if you peel back the layers, there's a really interesting story here. Strategic shifts. Big growth plans. So our goal today is to give you a clear picture of how they perform these strategic moves and what might be next for them.
Sounds good. So just looking at those headline Q2 figures first, GAAP EPS landed at just 0.02 cents.
Ooh. Yeah, the consensus was way higher, like $0.14.
Big miss there. And revenue also came in light, $43.36 million.
Against what? $44.71 million expected.
Right, so that's an 18% drop compared to last year.
And it wasn't just the top line, right? Profitability took a hit too.
It did. Adjusted EBITDA was $24.7 million. That's a 35% margin.
Which sounds okay in isolation, but it was 53% last year.
Exactly. So quite a significant drop year over year. Pretty tough initial numbers, like you said.
Absolutely. And those numbers, well, they definitely spooked the market a bit initially. Some pre-market selling.
For sure. But here's where it gets interesting. The stock actually bounced back pretty quickly during the main trading session.
Which kind of suggests investors maybe looked past that immediate miss.
I think so. It suggests they maybe bought into the company's explanation, the strategic story behind the numbers.
Yeah, because it's fascinating, isn't it? You see those headline figures, which could signal real trouble. But then you dig into the operating metrics and they paint a very different picture.
What did you see there?
Well, SBC now has 259 franchise clinics. That's up 36 from last year.
Okay, so network growth is still strong.
Right. And get this, the 72% repeat visit rate. That's incredibly strong customer loyalty.
Wow, 72%. That's huge in this space.
And they clocked 6.31 million customer visits over the last 12 months. It feels like a disconnect, almost.
It's a really critical distinction, isn't it? The financials seem to reflect a deliberate pullback in certain areas.
Not like the core business is collapsing.
Exactly. Those operating metrics, the clinic growth, the repeat visits, they really show the underlying health. Strong engagement, network expansion. It's almost like they're, cutting some weight to run faster later.
Okay, so let's unpack that. Those Q2 headwinds. What exactly was putting the pressure on revenue and profits?
Well, management was pretty upfront about it. They said the revenue pressure was mainly from this strategic business restructuring they kicked off.
The one from 2024, 2025.
Yeah. It involved getting out of some non-core areas.
Yeah.
Specifically staffing services. And they also deconsolidated some affiliates.
So basically streamlining the ship.
Pretty much. Just focusing the business.
Were there other things dragging down the top line besides the restructuring?
Yeah, a couple other things. They revised their franchise fees back in April, and they also saw more customers cashing in their loyalty points than expected. So both of those hit the reported revenue directly.
The loyalty points. That makes sense.
But on the flip side, they did get a bit of a lift in procurement and dental revenues. That was thanks to some device refreshes.
So some underlying strength in certain segments, at least.
Right. Shows the core operations are still ticking along.
And what about that high tax rate? That jumped out, too. Management called it a one-time advance payment. Should we be worried about that lingering?
That's a good question. They put it down mostly to a couple of specific things. Some executive compensation wasn't deductible, apparently.
Okay.
And there were some temporary timing differences on recognizing gains from aircraft sales between Japan and the U.S. rules.
Aircraft sales. Interesting.
Yeah, seems a bit random, but they were quite clear these were concentrated in Q2. So the expectation is it paves the way for improvement.
So likely more of an accounting blip than a fundamental issue going forward.
That seems to be the message. And the market reaction suggests investors kind of accepted that explanation.
Okay, so it sounds like a quarter full of deliberate, maybe painful choices that hit the immediate numbers.
Definitely seems that way.
But despite all that, management sounded really confident. They said the groundwork has been laid for growth to pick up speed from Q3. They even mentioned their never give up spirit. What's behind that optimism?
Yeah, this is where the story shifts, really. A huge part of that confidence comes from strategic acquisitions, especially the JUN CLINIC deal they closed on July 17th.
Right. That added 6 clinics.
6 clinics, yes.
Yeah.
But as what kind of clinics? They specialize in fixed-price, diagnosis-led laser treatments.
Fixed price. Interesting angle.
Very. Because JUN CLINIC's model is apparently super profitable, high customer satisfaction, really strong retention, and crucially low marketing costs.
So it's not just adding doors, it's adding a high-margin, efficient model.
Exactly. It shows SBC is laser-focused, you could say, on these sticky, high-profit revenue streams. It's a really significant move.
And they also launched something new internally, right? Neoscene Clinic.
Yeah, back in April. This one targets, like, expert-level customers, people looking for more advanced treatments.
So a different market segment altogether. How's that doing?
Apparently, it's been a huge hit. Quickly gained traction. The average spend per customer is higher than their existing clinics.
Wow.
And they said it was the fastest ramp-up they've ever had for a new concept clinic.
So they can acquire and innovate successfully. That's a good sign.
Definitely. It shows versatility.
And these new concepts, JUN and Neoscene, they fit into this much bigger picture, right? This massive clinic expansion plan.
Oh, yeah. The ambition is huge. They want to go from the current 259 clinics to 1,000 clinics in Japan.
1,000 within 10 years.
Within 10 years. It's a massive goal.
How are they planning to get there? Just more JUM clinics?
Well, that's part of it, but they're also working on a new hybrid model clinic. This one's aimed at entry-level customers.
Hybrid, what does that mean?
It means combining treatments a customer pays for, directly self-funded, with treatments covered by insurance.
Okay. So making aesthetic medicine more accessible.
Precisely. The idea isn't just a fight for existing market share. They're trying to actually expand the whole market in Japan by bringing in new people who might have been put off by cost before.
That's clever. So you've got the high profit acquisitions, the high-end innovation for experts, and a model to grow the entry-level base.
It's a really thought-out multi-brand strategy covering different segments, different price points, from affordable dermatology right up to, global advanced treatments.
Covering all the bases.
Trying to. And beyond that general aesthetic market, they're also pouring resources into specific high-growth areas, like orthopedics.
Orthopedics. That seems a bit different.
It is, but they see potential. They're expanding from just short stature treatment into joint pain therapy and rehab. The goal there is to go from 7 ortho clinics to 100.
Wow, another big jump.
And they're not stopping there. They're making a serious play in AGA, that's hair loss treatments. They want to be #1 in Japan in just 1 or 2 years. And #1 in fertility within 10 years, offering comprehensive treatments, not just pills.
These are very specific, very ambitious targets in profitable niches.
Absolutely. High demand, potentially high margin. But, the vision isn't just limited to Japan.
Right. You mentioned international plans earlier.
Yeah, they're serious about it. Strengthening their U.S. structure, launching Japanese language services in Singapore.
Okay. Serving expats or medical tourists?
Probably both. And what's really striking is how active they are on the M&A front overseas.
Where are they going?
North America, obviously, but also Malaysia, Thailand, Vietnam, Indonesia, really casting a wide net in Southeast Asia.
Interesting mix.
And they're also boosting medical tourism, specifically targeting Chinese tourists, using platforms like Red A, the big social media app in China.
Yeah, little Reddit.
Right, and hosting events in Shanghai. It's a very clear outward-looking growth strategy, planting flags globally.
Okay, but to pull off this kind of massive expansion, especially internationally, you need the right people. Have they been beefing up the leadership team?
They have, and it seems very targeted. Back in July, Dr. Stephen R. Cohen came on board as medical strategy advisor. That adds serious medical weight.
Okay, makes sense.
Then in April, Stephen Rogers joined as head of international strategy. His background: Amazon and Rakuten.
Oh, wow. So serious e-commerce, M&A, business development chops.
Exactly the kind of experience you'd want for international M&A and expansion.
Good hire.
And finally, Shenya Aino is the new Chief Marketing Officer, a real veteran P&G, Eli Lilly, Adobe.
Another strong background, global brands.
Right. The goal there is clearly driving global branding and marketing. These aren't just random hires. They directly map onto those big growth plans, especially the international push.
Okay, so the strategy is ambitious, the team looks stronger. The next question is always, how are they paying for all this? And what about shareholders? Let's pivot to that investor context.
Sure. Well, financially, they seem pretty solid. They've got $152.7 million in cash and equivalents.
Okay.
And shareholders' equity stands at $244.65 million. So a decent war chest.
And that cash is earmarked for this growth?
Explicitly. For organic growth, both in Japan and overseas, and for those strategic M&A deals we talked about.
Got it. But I remember reading something about their stock liquidity being a bit, tight, maybe tough for big institutions to trade.
That's been a known issue, yeah. Limited liquidity can definitely be a hurdle for larger investors.
So what are they doing about it?
They've taken a couple of steps. First, they did their first ever share buyback, running from May to July this year.
Okay, buybacks usually help support the price and can reduce share count.
Right. They believe it had a positive effect on both the share price and liquidity. Second, they got added to the Russell 3000 index back in June.
Index inclusion. That definitely boosts visibility.
And should improve liquidity over time as index funds have to buy in. It opens them up to a much wider pool of potential investors.
Are they thinking about anything else to improve trading or raise capital?
Yes, actually. Management openly mentioned they're considering options like a new share issuance.
Issuing more stock.
Or potentially having the founders sell some shares. The goal is to increase the float, basically, the number of shares readily available for trading in the market.
Which would make it easier for those big institutions to build positions.
Exactly. And it would also ensure they have enough capital for future investments. They said they're aiming for a balance between, shareholder returns and funding this aggressive growth.
It sounds like a very proactive approach to capital management, thinking long term.
It does. Very deliberate.
So putting it all together, the feeling after earnings seems, cautiously optimistic, constructive.
I think that's fair. Investors seem willing to partially discount the Q2 miss, giving management credit for the strategic moves and these liquidity initiatives.
But the proof is in the pudding, right? They need to deliver on that Q3 acceleration.
Absolutely. That's the key.
So, for you listening, what are the main things to watch? The key catalysts.
Okay, number one, definitely keep an eye on any updates about JUN CLINIC. How's the integration going? Is it delivering the expected profitability?
Right.
Number two, any more M&A news, especially those international deals they mentioned. And number three, the absolute crucial one, confirmation of that Q3 growth pickup. We should get a clearer picture around the next earnings report, probably mid-November.
And beyond the headlines, what underlying metrics should people focus on?
Pay really close attention to the commentary on repeat customer behavior. Is that 72% rate holding up? Also, their pricing strategies, are they maintaining pricing power? And device utilization rates.
Why device utilization?
Because it's a leading indicator. It tells you if they're successfully driving traffic and higher value treatments through their clinics. These metrics will show if the strategy is translating into sustainable growth without just crushing margins. Got it. Crucial leading indicators. Okay, now for something a little different. This is not financial advice segment. Just some ideas to get you thinking, purely illustrative.
Right. So management sounds really convinced that Q2 was the bottom, that the groundwork has been laid, and those headwinds were one time.
They do sound confident.
So if you buy into that narrative, if you think Q3 is going to show that acceleration, one way you might think about playing it, and again, not advice, is looking towards that November 12th earnings report.
How so?
Well, you could consider something like a long calendar spread, maybe buying some out-of-the-money calls for November.
After the earnings.
Right. And selling the same strike call, but for the October expiry, so before the earnings.
Okay, what's the thinking there?
The idea is you capture a potential big jump after the Q3 results if they really deliver, using those November calls. The sold October calls help offset the cost and hedge against volatility before the announcement. If they hit that Q3 inflection point, those November calls could see some serious gamma expansion. Interesting. A bet on post-earnings upside, hedged beforehand.
Basically. Capitalizing on that reacceleration story if it pans out.
Okay, what's another angle? Maybe something longer term.
Well, thinking longer term and remembering management talking about potentially issuing new shares or founder sales to boost liquidity.
Which should attract more institutional money over time.
Exactly. That fundamentally suggests a more stable, maybe upward trending stock price as broader interest builds. So an alternative could be something like a put right strategy.
Selling puts.
Yeah, selling deep out of the money puts, maybe 6-9 months out. The idea is you collect a potentially attractive premium now.
Especially if the stock stays stable or drifts up with better liquidity.
Right. Your risk is basically owning the shares if they fall below the strike price, but you'd acquire them at that strike minus the premium you collected, so a discount.
Essentially getting paid to wait with the potential to buy the shares cheaper if they dip, betting on the long-term improvements like the JUN CLINIC model working out.
Precisely. It's a slower approach, but could offer decent yield if you believe in their long-term market penetration and M&A integration story.
Two very different ways to think about it, depending on your view and timeline. Okay, let's wrap this up.
So to recap, SBC Medical Group, Definitely a challenging Q2, no doubt about it. Shaped by that restructuring and some temporary hits.
But management is sticking to their guns, emphasizing that strong repeat customer base, their unmatched scale in Japan, and these key acquisitions like JUN Clinic.
All aimed at hitting accelerate on growth starting basically now, from Q3 onward.
And they're actively working on making the stock more accessible too, with buybacks and potentially more shares coming to market later.
But the credibility really hangs on delivering that promised growth acceleration in the next few quarters.
Absolutely. Which leaves you with a really important question to ponder. How will this multi-brand strategy, adding JUN, Neoscene, and these new hybrid clinics, actually reshape the aesthetic medicine landscape in Japan? Can they really expand the whole market?
It's a big bet they're making. The next few quarters are going to be critical in seeing if it starts to pay off.
Indeed. Now, just a reminder, this deep dive into SBC Medical Group's Q2 earnings is purely for informational purposes. It is absolutely not financial advice.
We strongly encourage you, do your own research, your own due diligence, and always consult with a qualified financial professional before making any investment decisions.
We'd love to hear what you think about SBC's strategy, or if there are other earnings calls you're tracking closely. Find us on social media. Let's keep the conversation going.